Good evening, everyone. This is Dana from NexGen. I hope you're enjoying Me Inc.'s weekly series. In this live, we are discussing the health savings account. Last week, we did a 2022 budget. One of the things Angela wanted to look into was a health savings account. And again, Angela's not her real name, and this is not her picture. Information about the health savings account can be found in IRS publication 969, which is the health savings account and other tax favored health plans. The link is in the description below. A health savings account is a tax-exempt trust or custodian account you set up with a qualified HSA trustee to pay or reimburse certain medical expenses you incur. You must be an eligible individual to qualify for an HSA. Eligibility includes being a U.S. taxpayer enrolled in a high-deductible health plan, and I'll tell you about what that means shortly. The funds are not subject to federal income tax at the time of the deposit, and the funds are not what we call a use it or lose it, and they belong to you. To qualify, you have to be covered by a high deductible health plan on the first day of the month. As a side note, there is what they call a last month rule. And under the last month rule, you are an eligible individual on the first day of the last month of the tax year. And that's usually December 1st for most taxpayers. And you are considered eligible for you're considered an eligible individual for the entire year. You are treated as having the same high deductible health plan coverage that for the entire year as if you had done it on the first day of the last month if you didn't otherwise have coverage. So what I mean by that is if this is your first time and you do it, let's say before December 1st, because it has to be the first day. So let's say it's November 1st or December 1st, you will be considered having the coverage for the entire year. Now, you can't have any other health coverage except what's permitted under other health coverage in publication 969, and that's on page 4. You cannot be enrolled in Medicare or be claimed as a dependent on someone else's tax return. The contributions that you make are tax-free. Now, there are some limits that I'll provide shortly. Your employer can also make the tax-free contribution. Now, I need to let you know that the employer's contribution is part of what we call the contribution limit. The interest grows tax-free. So the money that you put into the account actually has interest, and that money grows tax-free. You can invest the contribution, and I'll talk about that more later. The withdrawals that you make for qualified medical expenses are not taxed. Before 65, if you withdraw the funds for other than a qualified medical expense, you could pay a 20% penalty. After age 65, you can use your health savings account for any expense. However, you would pay ordinary income tax on any amount that's not used for qualified medical expenses. So the bottom line is, if it's for a qualified medical expense, there is no tax. If you take it out for other than a qualified medical expense, then you're looking at, in addition to taxes, a 20% penalty before the age of 65. And then after 65, it's just the regular ordinary income tax. Here are examples of qualified medical expenses. These are the 2022 annual contribution and high deductible health plan limits. Now notice the catch-up contribution at age 55. And again, the annual contribution includes what you contribute and your employer. Those are the limits for an individual and the family. And then when we talk about high deductible health plans, that's what we're referring to. Let's do a scenario with Angela. After careful consideration, Angela enrolled in a high deductible health plan before December 1st. Her employer contributed $650 and she contributed $3,000 before April 15th, 2022, which maxes out her contribution. She plans to use her HSA as an investment account. This means she does not plan to make any withdrawals for any qualified medical expenses until she turns 65. She keeps her receipts for all qualified medical expenses since her enrollment. So since her enrollment December 1st, she keeps all of her receipts for the qualified medical expenses. Because she's single, she named her eldest son as the beneficiary. If she dies, the account stops being an HSA and the fair market value of the HSA becomes taxable to her eldest son in the year in which she dies, the eldest son, which is the beneficiary. This amount is reduced by any qualified medical expenses for Angela that are paid by her son within the first year after the date of her death. If Angela got married and named her husband as a beneficiary, the funds would be treated and moved into and function as her spouse's HSA after her death. So let me back up. So remember, she kept all the receipts for her qualified medical expenses. Hopefully she has it in one place. So if the son pays all those qualified medical expenses, he does that within the year from after the date of her death, then that amount is reduced. So whatever the difference is what would be considered taxable. Let's say that she didn't die and she didn't get married. If she and her employer maxed out her contribution and she subsequently added the $1,000 catch up when she turned 55, at a 5% growth rate, she is looking at over $130,000 tax-free at 65, and she can use these for medical expenses, qualified medical expenses. At 65, she collects her qualified medical expenses that remember those receipts that she had, and then she's reimbursed at that point tax-free. So instead of the lower amount, she is investing that money and using the higher amount for her reimbursement. And then, of course, she can do what she pleases with the rest. Someone had asked a question about the forms. These are the forms that would be used for the year, each year that she has the HSA. I hope this information was helpful. Don't forget to put your questions in the chat or in the comment section below, and I will see you next